The CEO of one of the most profitable AI companies in the world just said that something has gone completely wrong with how OpenAI and Anthropic charge for their products. That is not a startup founder venting on a podcast. That is Alex Karp, who built Palantir into a business that actually generates real operating income from AI deployments. So when he uses language that direct about the two most funded AI companies on the planet, the question you should be asking is not whether he is right. The question is what he knows that the rest of us are still pricing in. Let us be precise about what Karp is actually criticizing, because the framing matters. OpenAI and Anthropic's core commercial model is built around tokens, the unit of text that their models process and generate. You call the API, you consume tokens, you get billed. It is clean, it is scalable, and it has allowed both companies to generate significant revenue. But Karp's critique, based on his public statements, is that something has gone fundamentally wrong with this approach. That phrase, something has gone completely wrong, is doing a lot of work. It is not a technical critique. It is a structural one. Here is the analytical framing that makes his position coherent. When you sell tokens, you are selling compute. You are essentially a metered utility. Your customer's incentive is to use fewer tokens, to optimize prompts, to reduce API calls. Your revenue grows when customers use more, but your customers are rationally trying to use less. That is a misalignment. Compare that to Palantir's model, which is built around outcomes, deploying AI into actual operational workflows, often in defense and enterprise contexts, where the value delivered is the metric that justifies the contract. The revenue logic is inverted. You win when the customer's operation improves, not when they consume more compute. Now, this does not mean the token model is doomed. Scale matters. Network effects on foundation models are real. But Karp's critique raises a legitimate strategic question. In a world where inference costs keep falling, what happens to the margins of companies whose entire revenue model is priced per token? The actionable insight here is that when evaluating any AI company's durability, the first question to ask is not how much revenue they generate. It is whether their revenue incentives align with their customers' success. The same week Karp is publicly questioning the token model, Meta is making a move that looks, on the surface, like a completely separate story. Bloomberg is reporting that Meta is building a cloud business to sell its excess AI compute capacity. The stock moved roughly 10% on the news. But here is why these two stories are actually the same story told from opposite ends of the infrastructure stack. Meta built an enormous amount of GPU capacity to train and run its own models, Llama and its successors. That investment was justified internally by the value those models create inside Meta's products. But now they have excess capacity, and selling that capacity to external customers is the obvious next move. What Meta is effectively doing is entering the commodity compute market, the same market where the token model lives. They are becoming, in part, a metered compute provider, which means they are validating the infrastructure play while simultaneously applying downward pressure on the price of that infrastructure. Think about what this means for the competitive landscape. When one of the largest AI spenders in the world decides its excess capacity is a monetizable product, it signals that GPU compute is increasingly commoditized, at least at the infrastructure layer. This is the dynamic that makes Karp's critique even sharper in 2026. If compute keeps getting cheaper and more available, the moat cannot live at the infrastructure layer. It has to live at the application and outcomes layer. The companies that built their revenue model on selling compute tokens are now competing, indirectly, with the excess capacity of hyperscalers who built compute for themselves first and are selling it second. That is a structurally difficult position. The actionable lens here: watch where differentiation is actually occurring. In AI right now, it is moving up the stack. Fast. There is a third data point from this week's headlines that deserves more attention than it is getting, and it reframes the entire narrative. Reports are surfacing that employers who laid off workers specifically citing AI as the replacement are already starting to regret those decisions. That is a significant signal. Not because AI is failing, but because it reveals something important about the gap between AI capability in a demo environment and AI capability in a deployed production environment. This matters for understanding the Karp versus OpenAI framing in a real way. The companies that moved fastest to replace human workflows with AI tokens, essentially treating AI as a drop-in substitution, are discovering friction. Workflows are messier than prompts. Institutional knowledge does not tokenize cleanly. The humans who were let go took context with them that the AI cannot reconstruct from a system prompt. Meanwhile, the enterprise AI deployments that are actually working tend to look more like what Palantir describes: AI augmenting structured workflows, with humans still in the loop on judgment calls, with the system designed around outcomes rather than around token efficiency. For software engineers specifically, there is a parallel story developing. Reporting from Business Insider this week notes that AI is not just changing how engineers write code. It is changing their professional identity and confidence. That is a much deeper disruption than productivity metrics capture. When a craft-based profession starts questioning what it means to be good at the job, the downstream effects on hiring, compensation, and organizational structure are real and long cycle. The actionable insight is this: the AI transition in enterprise is not linear, and the companies that are winning are not the ones who moved fastest to replace humans. They are the ones who redesigned workflows to make AI genuinely useful. That distinction is worth tracking carefully as an investor, as an operator, and, honestly, as someone building a career. We opened with a question: what does Karp know that the market is still pricing in? The answer, based on everything that landed this week, is that the AI business model layer is bifurcating. Compute as commodity versus outcomes as moat. And the companies on the wrong side of that split are facing margin pressure from multiple directions at once. The follow-up question, which we are going to dig into next: which specific enterprise AI players are actually built for the outcomes model? And how do you distinguish signal from positioning in their earnings calls? Subscribe so you do not miss it.